What should the Federal Reserve do next? By www.forexconspiracyreport.com. When the U.S. Federal Reserve indicates that they will raise interest rates in the near future, stocks and currencies around the world go down. And when the Fed indicates that they will go ever so slowly in raising rates, the markets and international currencies rally. The issue for the Fed is staying ahead of inflation with rate increases while not choking off the economic recovery. What should the Federal Reserve do next? It depends on whether you think inflation or the economic recovery is more important. According to CNBC, the Fed may hike interest rates faster than currency expected. The market shouldn't be ruling out the possibility the Federal Reserve will hike interest rates again this year, William Dudley, president of the New York Fed, said on Monday. Dudley said he expected the U.S. economy to grow around 2% annualized over the next 18 months, boosted by improved consumption. If the upcoming information validates my view of the outlook, then U.S. monetary policy will need to move at a faster pace than implied by futures prices to a more neutral posture as the labor market tightens further and U.S. inflation rises, Dudley said. Dudley also said that the markets also seem to be discounting the likelihood of faster economic growth in the next year or so. Rethinking everything. According to the Washington Post, the Federal Reserve is rethinking its strategy. The Federal Reserve is being forced to reevaluate its most basic assumptions about the economy after trillions of dollars of stimulus and years of ultra-low interest rates have failed to generate a more robust recovery. For years, the central bank's top officials pointed to persistent headwinds emanating from the Great Recession as a culprit for the tepid pace of the economy's expansion. Government spending cuts were depressing growth. Households were paying off debt, spending less and saving more. Borrowing money got harder. Once those trends turned around, they argued, the economy would get back to normal. 7 years after the recession officially ended, many of the headwinds have indeed dissipated, yet normal remains elusive. In its place is a gnawing fear that the economy has permanently downshifted into an era of weak growth that policymakers have little power to reverse. Fed officials have all but given up hope of the 3% rate of expansion once considered the baseline for a healthy economy. It used to be that when the economy weakened, the Fed lowered interest rates, and when it overheated, the Fed raised rates to hold off excessive inflation. But what should the Federal Reserve do next when years of low interest rates have failed to generate a healthier recovery? The evolving consensus is that growth will remain slow for the long term. Thus, there will be no need for excessive interest rate hikes, as inflation is not going to come roaring back, not at least until the global economy mends. Slow growth or shrinkage everywhere. We live in a global economy. Forex traders know this better than anyone else. With Japan and Europe in or on the edge of recession, and China readjusting to world normal growth rates, there is no growth engine outside of the USA to stimulate the world economy. What the Federal Reserve should do is not raise rates until inflation rears its head, if it ever does. For more insights and useful information about Forex markets and trading, visit www.forexconspiracyreport.com.